Hey, welcome everybody to the 40 Finance channel. Jumping on here for a quick live stream before lunch in my side of town, Eastern Standard Time. And we're seeing some market weakness today, a lot like we've seen over the past couple weeks. And at least in my opinion, I think you go slow in terms of buying the dip in this particular scenario. And if you're not familiar why, you can see it here on the front page of Yahoo. Stocks drift lower as traders look ahead to Fed decision. You never really know for sure if these headlines are the actual reason that we're down a whopping, 1.17% in the NASDAQ. But the fact that this Fed meeting is not coming until Wednesday makes me think that you might have some more time. Let me get this sorted out here. It leads me to think that we might have some more time to buy the dip, and it's not necessarily a panic situation, that you need to rush in and try to find some of these stocks. This whole catalyst, if you're calling the Fed meeting a catalyst, it's not coming until Wednesday. And you see the bullet points here. The consumer inflation reading reinforces the narrative that Fed Reserve will quicken its pace to taper asset purchases, setting the stage for an earlier rate increase. Investors will gain insight on central bankers' expectations for when rates will rise with the release of the summary of economic projections, especially the closely watched dot plot. Expect to see change in timing for winding down, blah, blah, blah. Fed Chair Jerome Powell has already said it's time to talk about speeding up the taper. And I wanted to see exactly when this meeting is coming out on Wednesday. They may not have it right here. So I just know that typically when the Fed releases reports like these, there's usually not a press conference until the afternoon, so 2 o'clock or so. But my whole point here of doing this live stream is if you see your favorite stocks going down, I wouldn't do much more than nibble at them at this point, because I think that every day that we get closer to this meeting, we might see another 1% down and another 1%. And I guess at the end of the day, if you're long-term, 1% isn't really the end of the world. But there's a couple things that if you watch the channel that I've been following, particularly in the NASDAQ or more specifically the QQQ, you still have companies like Apple. Oh, I hate how this screen doesn't center, and I'm still learning how to get good at it. You still have companies like Apple, which has had an outstanding year. They're still sitting at historically high P/E ratios for them. Same with Tesla, which has dripped down just a little bit. But you see the year to date, your peak was $1,200. Now you're down to $1,000. I would argue that Tesla has more room to go on this P/E ratio anyway. And then over on the Microsoft side, they're basically running flat. Their P/E ratio at 38. You can make the argument that they just have a couple points. I'm not talking about Microsoft crashing here. Okay, that's not what I'm saying. I'm not saying Microsoft isn't going to be the best daggone investment for the next 5 to 7 years, because it very well might be. But what I'm saying is, with what we've seen with growth stocks and the valuation multiples coming down, I say this time and time again, I think there's some room in Microsoft that it could go down. Now, maybe going down is $330, $325. Maybe on the Apple side, it only goes down to $165 or something like that. But the reason that I highlight these stocks, as well as another big one that's been on fire, NVIDIA, which did have a drop off. Oh, that was in June. Never mind. Let's look at the past 1 month here. NVIDIA is only down to their roughly mid-November level. So maybe this one could potentially go down to 270. I'm just making these numbers up. I just want to illustrate the fact that I'm not talking about these stocks tanking, okay? What I'm saying is if you get little clips off of each one, now all of a sudden, when we look at the QQQ, those are huge components of them. And I'll try to squeeze this in. Talked about this a lot lately, but if you put Apple at 11%, whoa, that's a lot of blue. You put Apple at 11% of the QQQ, Microsoft's 10%, those two stocks alone, right? 20%. We looked at Tesla, that's another 4. We looked at NVIDIA, that's another 4. So in 4 stocks, you're talking 28%, and we didn't even get into Google. I think Facebook's had a relatively solid drop-off from a valuation standpoint. Let's see what Google's at in terms of recently. 1.4% today. And from a 1-month view, you know, November 15th, it was 29.86. Now you're at 29.30. So through this whole gap down that we saw in the growth names, you know, Google's basically back where it was a month ago. So long story short here, I do think that there is a little bit more room to run, particularly in the top names. And so if you got 5%, let's just say, over the next 3 days before the Fed talks, if we got a combined 4 or 5% off of Apple, Microsoft, Google, NVIDIA, Tesla, etc., if those big dogs get hit like that, then you know, I would anticipate the QQQ would also be down 4 to 5% in those few days. And that's when I think you can start to feel a little bit better about getting close to the bottom, because Apple, Microsoft, NVIDIA, etc., they are not wildly overvalued, but they are a little bit higher than their normal metrics if you go back to pre-pandemic times, right? Which, by the way, when I say go back to pre-pandemic times from an economic standpoint, that means slightly higher interest rates. We didn't have historically high interest rates in 2019, but we could be going back to that place, the 2019 level, in 2022, and my anticipation would be that stock valuations start to get back to their historical averages. And that can still mean that Apple, Microsoft, etc., can continue to be the awesome companies that they are, increasing EPS, increasing revenue, all those wonderful things that they've done for so long. The only thing that shrinks is the multiple that people pay for those earnings and revenue. So that's what I'm throwing out here. We'll see what happens. You know, at the end of the day, if you're a long-term investor, if you're 5 years on Microsoft, okay, from today, okay, fine. Maybe it just doesn't matter that you buy it. But if you're looking to establish a new position in almost anything right now, particularly high growth names, if you're looking to establish a new position that you have nothing in, and your hope is that you don't go negative in your first 60 days of owning the stock, then that's where I would say, okay, be very patient. If you're so antsy that you have to buy something on a 5% dip or whatever Tesla was there, let me look real quick. Yeah, Tesla's down 5.5%. Let's just say you've been waiting forever to get into Tesla. You don't want to get it as it's melting down. Then the other opportunity here, let's just go small. Let's say you want to build a portfolio of 10 shares of Tesla, and you're like 5.5%. It's under $1,000. Should I get it now? You know, on my side of the camp, I would say Tesla has more room to run down, but I would say buy one share today. Satisfy the itch, buy one out of your 10 shares, and wait and see what happens the rest of the week. I can't imagine that when Powell does speak, that he is going to shock the world. I think what the problem is with these stupid Fed meeting things is there's no precursor. It's just the big wigs on TV making guesses, and nobody knows, and they don't release any notes ahead of time, so really nobody knows. And then we sit and dissect words back and forth, but folks are so antsy prior to those words coming out that they freak out like they're doing here. And they get into that worst case scenario method where they're like, okay, if he's going to put interest rates up 2%, which is never going to happen in a million years, then the market's going to drop like a tank. I don't see that scenario. However, the certainty of him speaking, the certainty that comes out with him saying, all right, and I really think that this is what he should do, by the way, is come out and say, in 2022, roughly before March 1st, we see the first interest rate hike coming up. If it was today, we see it at 0.1% bump, whatever it is. And that would bring a lot of certainty to the market, but they don't talk like that. They talk in maybes and probablys and speculation, and that's what leads to these really wacky worlds where we have kind of FOMO, right? Or maybe it's not FOMO because you don't want to miss out, but just fear index in general. So that's what I'm looking for me personally. I'm building up some QQQ here recently. As you guys know, been a tough year for individual stocks unless you are in the big 5 or 6 FANG names, whatever you want FANG to be. If you were in Tesla, Nvidia, Microsoft, Apple, probably 2 or 3 others that I'm not thinking of, you had a really good year if those were your individual stocks. Almost everybody else, to some degree, minus maybe energy and nitpicking around industrials, then you're probably staring at a deficit. And if that, for me, I'm in that category. So I'm going to be building up my QQQ as a percentage of my portfolio to kind of help against that. And so I'm watching the QQQ very, very closely because I do want to build up a strong position in my retail account to go with it. I already have, between my ETF account that I share here and the SEP IRA and then other retirement accounts, I have a zillion QQQs probably across the board, but I want to bring it into this portfolio because I need that hedge. And I think, my 2 cents, I think QQQ has the best companies in the world, and long-term, 5-7 years, that's probably not going to change. Just my 2 cents. So, all right. So I got right to the point there, and I see a couple of you chimed in with some questions, so I'll jump into those. And we have Saeed said, don't buy anything yet. I think I explained myself, Saeed, when you came in, but yeah, I'm saying at best nibble before Wednesday. There will be a trick to Wednesday that's probably not worth playing, of the sort of buy before or after the press conference. I don't have that many shares at stake. I'm not in 10,000 shares of Apple or anything like that where it'd be worth my time. I think if you're long term, you just wait to see when stuff kind of gets closer to that meeting time, and maybe you buy some before and you buy some after, however you want to do it. I mean, at the end of the day, what am I talking about? I'm talking about dollar cost averaging. Just in this sense, I think when it's normal times, you dollar cost average, maybe it's on a weekly or monthly basis. I think you have a unique opportunity this week because we have sort of a fear factor going, and I think it's a unique opportunity to take whatever you are doing from a DCA perspective and maybe for this 1 week just hyper focusing on the days and times that you buy, see if you can get the best out of it. That's what I'm doing anyway, but as always, you have to make the right decisions for you. Kingdom of Jordan says buy TNXP, which is levered. Let's see if that's levered or not. Treasury. Oh, that's not even close. You're on penny stocks, which we don't do a lot here. I don't want to disappoint you. I thought he was talking about TNX, which is not it. There is. Let's see if I can bring it up here for you. There is a 30-year ETF that people play in as sort of the opposite side of the QQQ. Is it TMF? I'm very sorry, it may not be. Let's just try TMF. Here it is. All right, so this, just as a general knowledge point, there is a very popular strategy. I've actually been researching a lot here lately. I'm not sure if I'll do it exactly like some of these folks do, but TMF is basically a leveraged ETF that is bullish when interest rates go up, right? So if we scroll, try to get this to show up right here. Okay, so the 10-year today, now that's 10-year and this is 20-year, so there's a little difference here. But the 10-year is actually down 4% today to 1.41%. If this was the 20-year, I'm guessing the 20-year is up because, at least very slightly, because this levered ETF is up almost 5%. And the game that you're playing here is you would basically be bullish, put this at a high level, you would be bullish long-term on QQQ, but you're also recognizing that the enemy of the QQQ and high growth names is interest rates. So you'd have a portion of your portfolio in this TMF. There's a lot more subtleties to it that you'll need to read on your own. I recommend, honestly, Reddit is probably where I've read the most people talk about this strategy. And so I don't want to quote exactly what it is, but it's very roughly, do your own research here. Call it 70% QQQ, 30% TMF as an example. Please do your own research. And then what you get in this particular environment that we're in now, okay, you get some downside protection if interest rates go up high, which would inevitably bring the QQQ down. So this thing would go up, QQQ would go down, and there you go. That's how those worlds balance each other. And then in both cases, because it's levered 3x, you obviously, as you can see here, could lose quite a bit of money in a short amount of time. So it's absolutely imperative that you would buy the dips or have a DCA model that you are very strict with. There's a DCA model for this strategy let's see, they had identified 4 or 5 times in the year when the market is historically less volatile, and that's when the folks who follow this particular strategy go forward. So anyway, long story short, that's just something for you to go read. Go read on Reddit, and I would say, let me see if I can find this for you. Let me see if I can find this Reddit thread. Is that showing up? Oh, look, I never understood Reddit live streams, by the way. This particular one, I'm sorry, I'm going off topic here, but this particular one looks like, it's just cats. I see DJs in here. I see folks playing guitar, which is all well and good. I just don't know who the hell watches like cats for a long time. and I have a cat. I just don't know who's doing this, but whatever. Let me see if I can find this thread. It should be on one of my top threads on my homepage. Come on. It didn't have a lot of action today. Let me see here. R dash. Here it is. This is the whatever, the one that you should join. I'm just gonna fix it so you can see. As far as reading and learning, this is TQQ, TQQQ, and you guys can go through here. Everything I know, I've learned from here, and you can get people's different opinions on it. But they're basically running levered QQQ against levered Treasury, that TMF, and everybody has their opinion on how how they're going about it. So something new for you to dig into today while you're waiting patiently for the best deals on the stock market. All right, I'm going to take some questions here. Let me grab a drink real quick. Kingdom of Jordan is in on Dogecoin. That's another one, just to let you know, Kingdom, we don't do a ton of that over here. I do have some Dogecoin, a very small amount, over in a Webull account just for kicks, in case, I could turn whatever, $100 into $500. Maybe that day will come. I have no idea. But it certainly is not the thing that I'm looking at on a daily basis. Do you think Fed will increase the taper rate? I do. Conversation of money. I do think that it's time for change from the same old. And while I think that Jerome Powell has been very clear on his expectations of the job market and such before he does make moves, I think the sandbagging time is over. And from my perspective, and I don't know how you guys feel, but from my perspective, I'm tired of the speculation. I'm tired of them, maybe we're going to do something, talk. And I'd really just like them to say, we're going to dip our toe in it and we're going to try it and see what happens. Because I don't think we can continue on this path the way it is right now. And I think that there is, even if stocks take a hit, I think there's a lot of benefits for moving towards a more normalized level of interest rates, let alone tapers. I think interest rates going up slightly is probably good for the American consumer in terms of housing prices. What you're going to see in housing will be funny to a lot of folks who haven't seen these changes maybe happen across time. You're going to see the price of housing go down, but the total cost of ownership is probably going to be about the same. All right. So what I mean by that is, the price will come down, the interest rate on your loan will go up, and at the end of the day, it's not going to lead to super affordable housing to come out of an interest rate hike, but it will change some markets, and it will make the biggest change probably on the cheaper markets, right? So assuming you have a good credit score, here in Ohio, you can still buy a $150,000 house. Okay, yes, you can still buy 500 and a million and all that, but there is a decent inventory, I would say under $200,000. And when those prices come down a little bit, and really that loan isn't a massive loan. It's a massive loan for us as individuals, but it's going to play itself out pretty well if you're just trying to run a family household. So that's my take. I do agree with the thought of tapering. I do agree with a minor interest rate hike just to get the needle moving in a direction that is more sustainable. But we'll see what happens. All right. Any thoughts on Robinhood? That's a good one. I don't own any. Last time I started talking about Robinhood, the power went out in my office and my live stream died. So we'll see if we can get through it here. I will say the most important thing for me about Robinhood is I am not on the platform. So it is very difficult for me to talk about the quality of the product. However, from the standpoint of the stock, it's very obvious. Here, the peak was 55. The IPO was 35. Now you're in 19. And let's see what we got as far as earnings go. This will be similar to Coinbase. It's going to be hard to project because it's going to be based on volume. This year, minus $7 or so obviously not profitable. But next year, this is a good sign if you're long that they're going to nibble on the edges of profitability. The high estimate of minus 16 cents. And then, the revenue is going to be the one from a comp standpoint. So comp meaning when they're going through their reports, right? When they have an earnings report next year in 2022, they're going to say Q2, for example, we made $500,000. That will not be at the same growth rate as they did this year, when at the beginning of the year, the stock market was absolutely fire, a lot of trading volume and activity. Probably not going to see as much of that next year. So just know that the percentage growth rate of 20% is good, and historically would probably put them in a top percentage of stocks, a bigger percentage, let's just say top 30% of stocks where revenue's growing at plus 20%. But it will not look as good next year. So let's see what our metrics look like. 10x price to sales and 2, 3, 4 on the book price. Who is comparable? Not going to be a ton of people comparable there. But let's just go to an old favorite, Charles Schwab, which is, guys, you really almost can't do this comparison because Schwab is more like wealth building, big accounts. But Schwab price to book, 322, so higher, and right about the same price to sales. Now, the difference here, of course, is that Schwab is making money, which Robinhood hasn't done yet. If I had to pick a side on Robinhood, I would say if you're a believer in the company, I don't think it's like the most overvalued thing I've ever seen. I mean, you lost another 5% today. Started at 20, you got down to 19. If you really, really, really want to buy it, and I recommend for the record that you buy companies with an EPS during this wild market, but if you really want to buy it, I don't know that 19 is horrible. I mean, hell, Morningstar puts a fair value of 26 on the stock, so it's not awful. That would be my quick take. It's not one that I own. It's not one that I'll likely buy, but this doesn't strike me as an absurd price. But you might even be able to get better than 19. Let's see. Thanks for clarification. Absolutely. What do I do with my Baba? Geez, man. I really do feel for you guys because I've been looking at this one. There's a lot of bulls at this price, understandably so. I guess where I sit with it is like, where's the bottom is what I keep thinking to myself. Where's the bottom? I haven't seen anything that suggests we're done. Even right now, RSI at 40, trending down to 34 today. So are we going to go back down here? RSI of 9 and lose even more? I don't know. It's got to be getting close, though. It's got to be getting close to the bottom. And as far as the upside goes, I think the answer is pretty simple. You need one article to come out from the government in China that says Alibaba is safe and that they're doing good things. So they did get a positive headline today. I didn't read the whole to-do about it. Let's see if I can find it. Okay, so yeah, something about their cloud business. Alibaba and Baidu continue to gain cloud market share, basically taking from Huawei and Tencent. And without going, the cloud units of Alibaba, Huawei, Tencent, and Baidu held a combined 80%. And Alibaba's cloud market share expanded 450 basis points to 38%, and which looks like that was the top of the growers. So that's good. Baidu grew 64% in Q3 thanks to its more significant customer base. I mean, this is a very bullish article, right? Alibaba grew 33%, la-di-da. So I don't know. Obviously, a business-related article like this that has to do with revenue and earnings is a good thing to see. I just can't figure out the bottom on that one. And I don't know that we will anytime soon. And if you own it, probably it depends on what price you paid, because there was some pretty significant drawdowns. And I'm trying to think of what I would do. If I owned it in if I bought it on February 14th or 15th, it was $263 at the peak. And now you're $120. I mean, I think you got to take some of that off the table. If you watched my video yesterday, it's kind of a boring topic, but I talked about FIFO, first in, first out, and what I did with Magnite, which is a similar disaster, just at a smaller scale. And the long story short on it, so here's Magnite. It's going to have a similar chart as Alibaba, except it doesn't have a big-time EPS like Alibaba. But you see a stock here that went from 50 in March, 60 in February. Now you're out at 17. I started buying around 40 right here after the second leg came down. But I've bought small, tiny lots all the way through. So what I did on my FIFO selling was I sold approximately 100 out of 300 shares, all of which I purchased between $40 and maybe $25. So I took this segment out, booked the tax loss. The only catch is I can't buy any more for 30 days here in the United States due to the wash sale rules. It sounds mildly unfortunate because you see here today, Magnite announces share repurchase program. That's fine. My cost basis fell to $25-ish, and I just don't think that there's going to be a huge run on this one for another 2 years, and then I think they have the potential to be a significant player on the sell side of connected TV. So I still feel good about it. But my hopes and dreams that it's going to 2x or 3x or something over the next 60, 90 days is probably zero, give or take. But still a good stock and one to think about, particularly at $17. If you're interested in that kind of thing, if you're interested in connected TV, maybe you're looking, for me, I was looking for maybe something that was less overvalued than Roku and Trade Desk, and that's where I landed at Magnite. Did not pay off very well in the short term. Now that I've got my cost basis down, who knows? Maybe I'll wake up in a couple years and it will all work itself out. All right, Tay, wanted to thank you when I asked about Corsair. Was lucky to get out even at a loss. What's your opinion at ARK? Currently down 25%. I think ARK is very intriguing right now. I don't know what you bought at. Let's bring it up. So to put it relative to myself, I hold ARK in my ETF account that I share on here, my SEP IRA. I haven't done an update on that one in a while. Maybe that's the next video I do. But I think I'm in the 100-ish average of ARK, somewhere in there. And I have no plans to sell. I would consider at 93 potentially buying like another share or two here and there. But there is a thought process when we look at the top holdings where you could say bearish outlook when you sit at my desk from a fundamental standpoint. So Tesla, I think, has more room to run. Look at this awful picture of Kathy, gee whiz. I think Tesla has room for the downside. It's my take, and that's 10% of it. I think Roku has finally reached, I wouldn't say it's on sale, but Roku is more normal. So I would say limited upside. Teladoc is a train wreck right now, but it's really not like super overvalued. I just don't believe in their moat. Square desperately needs a headline. They are a headline momentum stock. They have not had a headline of note for some time, except for, with Dorsey leaving Twitter. Zoom, I see as stuck in the mud, not doing a whole ton of stuff over the next 6 months. Shopify, if it wasn't so overvalued, I would expect this one to go up. So as I'm speaking out loud, Spotify, music is weird. I'm not super interested in Spotify. Twilio, I think, is... last time I did a Twilio, I think that there was some room to the upside. I can't remember. Coinbase is a crapshoot, completely based on Bitcoin prices, which a lot of folks would say they have room to the downside. Bitcoin prices, Unity, good company, I think still a little bit overvalued. So when I look at the top 10 holdings, to summarize, I think there is more room for the downside in ARK in the short term. However, if you are I don't think it's fair to judge ARK at this level at $93. I don't think it's fair to say that ARK is a dog for five more years. I think that if you buy in today, you've got to let these things play out because it is a long-term thesis. So I would be more likely to add small bits here than I would be to sell, but my expectation level on this would be potentially rocky road for another 60, 90 days and lower your cost basis. We'll see. The thing is about a managed ETF too, like this, these 10 stocks, theoretically, they could be completely different top holdings in 30 days. I mean, that's what's wild. So you actually, while the managed portion of this ETF has been, let's just call it disappointing this year, the fact that it's managed could raise it beyond expectations if some of these names drop out. Like, let's just say I'm managing it and I'm like, I don't know about Teladoc. Or, I got all my little research wizards next to me and we say Teladoc looks a little murky over the next 6 months, then we drop a percentage of Teladoc and maybe we buy into Twilio, which I think had some promising upside from a recent dip. So I don't know. I am not all down on ARK. The money that I invested in ARK is money that I don't need tomorrow, and I didn't expect it to provide for my family tomorrow. So I'm sticking with it. We'll see what happens. But anyway, Tay, thanks for the tip there. I appreciate it. Betty, can I say Betty Ann? Vark Tech. I'm guessing that's not something I'm going to know a whole lot about. Must be like a link or something. 150K, I'm not sure what Enrique's talking about. Roberto, please, any comments about Microsoft? A good point to buy. I mean, Roberto, if you're buying for 5 years, then buy one at a time during this weakness. Okay? I don't think it's a bad, there's nothing about Microsoft that's a bad stock. I mean, seriously, now their cloud continues to gain momentum. I did not highlight Microsoft today and talk about potential small downside because I think it's a bad company. Company is going to produce. I think all you're looking at with Microsoft and Apple right now is the strength of the stock market, and I don't think the market is super strong right now. I don't think it's a buyer's market. So if I was starting Microsoft today, maybe get your feet wet, buy one share, whatever you're comfortable with. I don't know how much you're starting with. And then this is a great week to watch Microsoft because the company is just out there selling and doing what they do, but this Fed stuff is a stupid cloud, and you might have the opportunity to buy tomorrow a slightly cheaper. You're never going to wake up and see Microsoft. I shouldn't say this, but you're very unlikely to wake up and see Microsoft down 20%. And if you do, boy, oh boy, is the market in general going to be in absolute chaos. So maybe get started this week on it. It seems like a good one. Dip your toe in and save some money if it goes down the next day by 5 or 10%, which would be huge. And you just add a little bit more. That's what's the beautiful thing about mega cap like Microsoft. And Apple's in there, Google's in there. It's so predictable, right? Their sales reports and everything. It's not like some of these other stocks where we're out here worried about their earnings because they only make $300 million a quarter, right? And if they get to 330, that's plus 10%. If they get to 270, that's minus 10%. That kills the small caps. Microsoft is gigantic, continuing enterprise contracts. I mean, they would know before they were going to be down 10%. I'll just put it that way. Thoughts on Shopify, still too high, AMD. So I can't believe that Shopify has not gone down more. And I'll say that in the sense from a valuation perspective. Okay, year to date was $1,000. Now it's $1,386. They've done good things this year, but it is a momentum stock from a valuation perspective. Trailing PE of 54, forward PE of 277. That doesn't even make sense. But here, from a PE perspective, 635 this year. We are weeks away, literally weeks away. Sorry, that just refreshed. From no one caring what 2021 was. Okay, all the focus on the stocks you're doing, in my opinion, should be 2022 and beyond at this point. This is not a huge gap up, 635 to 655. So assume the PE that you have today, at least in the short term, is going to be rooted in $6.50 for the foreseeable future. Certainly until their earnings report comes out. Next year's growth, phenomenal, 34%. That's got to be in the top Geez, I bet you 34% is in the top 10% of the total stock market in terms of growth rate. Certainly on the S&P it is, but it is down from the growth this year. So slowing growth leads to slower momentum 9 times out of 10. So I would say be careful. Shopify seems like it's a good company. They have outperformed my expectations wildly, but you got fair value of 862 on Morningstar side. You know, maybe that's the low of the low, but I still think there's room. There's still room here to get at to see it go down further. And honestly, everything I just said about Shopify, I can tell you is about what I think of NVIDIA. Phenomenal, great, super, slowing revenue growth. Morningstar fair value 194. EPS goes up slightly, but look at the EPS change and it looks like they run a non-traditional earnings calendar. So in 2021, they had 250. I don't know when their year starts and ends off the top of my head, but they doubled their EPS projection in this fiscal year. That's huge from a PE fundamental standpoint. Then next year, not as much. So if you went from 250 to 234, you added, let's just call it 50%, more than 50%, 60 or 70%. And then next year, you're adding, off the top of my head, 20 or 30% EPS growth. Okay, look at the sales numbers. Dropping to below 20% revenue growth. NVIDIA has room to go down. And it's not because they aren't doing awesome things. It's just where their valuation is. And we're seeing that now. Now, listen, 90 days ago, you couldn't tell anybody on the planet that NVIDIA was going down. And I would still say, if you're buying it for your older self, 5 years, 7 years, you're buying it for a kid's stock market account so he or she can see the ups and downs, then fine. But I would buy one share at a time right now because it seems like there's room for it to go. And that's just on that. When I say seems like, I'm just doing pure fundamental analysis. You can get into a side of the coin that my channel does not cover very often if it'll load, and that would get into momentum and whatnot. I do look at these indicators, but there's other people, specifically day traders and whatever, who have a deeper knowledge base. But you got RSI at 37-ish, 37, yeah. Last time it was low was October 4th. Stock price was 205. Okay. So if this goes down more, the stock price goes down more. That's the 2-second explanation of RSI. And I don't think we see anything in the market right now that says momentum up. So just be careful. That's the kind of the point of this video, is I think there's more time to just look at it. Playboy stock I'm not familiar with. LD, used car retailers getting crushed. Check out SFT, now trading. Okay. Revenue. Oh, wow. Less than 1 forward revenue. What's this one called? Shift. Yeah, this one I have heard of. So LD is a regular around here. It's calling out Shift Technologies. And this may not be as updated. Yahoo's always a couple of days behind on these, and you see this stock just melted almost 10%. Price to sales, not even 1. So that is definitely cheap. Looks like they're going to go backwards potentially on EPS, but still a 70% growth rate next year, where they cross the $1 billion mark. I could see this. This would, I mean, you know what I would call this is a dart throw that if you dig into the company and you're excited about it, I've never looked at one of their earning reports. I think this is similar to Carvana. Let me read it right here. I'll squeeze it in for you guys too. End-to-end auto e-commerce platform. Company operates retail and wholesale. Retail sale of used vehicles through its platform that enables mobile and digital transactions, on-demand test drive, purchasing at home. Okay, so maybe it's not dead on Carvana, but it's that same kind of world. So dig in. Out of curiosity, I'm going to look at TipRanks. See if they have any coverage there. And a small cap stock like this isn't always updated. You got a hold 7 days ago. 11 days ago, you had a buy at 9. You know, this, I mean, it does kind of feel like a dart throw that you've got to be getting close to the bottom on that one. But, you know, as I'm sure LDU would tell you, I would not expect $10 tomorrow, right? Not in the current market conditions. I think you buy into it and you see if the company can take off. And before you buy it, for God's sake, make sure you go to investor relations and read about what it is they do and what the CEOs and whatnot think that next year looks like. It's the weirdest car market we've ever seen, certainly since I've been alive. And there might be opportunities in there. All right, let's see. ARCG. So this is Joel Clark, ICLN, I don't know. Global Clean Energy ETF, I wouldn't know to say. Depending on who's in there. So you have to be, I would say, be extra cautious about stories right now. And I'm not saying that this is a story stock, but when things are going down, if this would have speculative names in it. Oh, here's holdings. Let's see. I don't know if they're going to have it because it's so small. Yeah, they don't have it. I can't see what's in there. But I would say that when the stock market was at all-time highs, people are going to say ESG investing and, you know, save the world and whatever. And then all of a sudden money gets real. And you might see some dropout. It just depends on who's in there. If it's got like Coca-Cola, what's the name of the waste? I can't think of it. Waste disposable companies. I mean, you're probably fine. But if it's a bunch of startups who are going to save the world with carbon fans and picking bottles out of the ocean, it might be a problem in the short term. And ARCG, as much as I follow ARCKK, and you know, been watching them since 18, I've never really bought into the genomics thing, but I can see where that'll be beneficial, and I think ARCG's down significantly because genomics are temporarily underwater, and so there's probably a game there. I'm not in it, and I would choose, I think when you see the whole sector down, might be time to dig in, read a lot more opinions, and pick whoever looks like the genomic superstar today, because that's where probably the gain is going to be, if you can be smart enough to figure it out. I can't read those reports, man. I'm not smart enough. Those are very scientific, complicated problems. And I say all the time why I don't invest in health and medical very often is because I don't understand it. And I can't read the reports. And I'm not a chemist. And so I stick with what I know. And when it comes to things like QQQ and other ETFs, then I can get into have some health exposure. But if you're waiting for me to read it and tell you that genomics is going to have plus so much sales because of XYZ, it'll never happen. I'd be guessing. Gonna say what's up to Lion. How you doing? We got diamond hands. Lion, I hope your light speed, I hope you got some profits out of that, because I noticed that it was struggling a little bit. Lion was an early adopter of light speed commerce, and I think he saw the run up. What a run up, $124, and then, growth names kind of mellowed out there. But hopefully for Lion, he's either got his strong thesis on why he got it in the first place, or he managed to sell and get out of the avalanche there. Nikhil, is it a good time to enter Apple for 5 years? I think for 5 years, yes. Is Google better buy? Get them both? Or can I say something, Nikhil? If you're going back and forth on those, I would, and now you're talking about Meta on the chat. QQQ, man, don't strain yourself. QQQ, start there. It's the biggest mistake I made in my retail portfolio in 2020 through 2021. Before I did this channel and started exposing some of that, I had QQQ, FDN, which is First Dow Jones Internet Trust, and IYC. That was like a core of the portfolio, and then I bought individual stocks. And the ones that I picked, at least this year, from the growth side of the coin, sucked. And I had sold those ETFs in the shortly after the pandemic, like a month or two, when stuff started to come back up. I sold all the ETFs because I wanted to have a portfolio that was single stocks only that I could share and talk with on the channel. And that was so dumb. So I'm building back up my QQQ, and if you don't have a lot in Apple, Microsoft, Google, whatever, so easy to get in there. And in my opinion, do slightly better than the S&P 500 because you're just sticking, you have a higher concentration of those names across each share. So hopefully that helps. I got to run, but let's see. Shanaz, you asked about Palantir. Good news for you. I just did a Palantir video. I like it, but as I always do in my videos, I do my sort of, top 5 things to know about Palantir. I think you'll enjoy it. I own Palantir, and since you came out to the live, I'll say that I do add some shares here and there on this downturn, but there's a lot to think about with Palantir. There really is. And I shared all the things that I know on this video that I'm working on, and hopefully will be up tonight. So something to look forward to, I guess. All right, guys, thanks a lot for coming out. I'm going to go get something to eat. Have a great day. Be patient is what I think. Be patient right now because I think that there's some negative catalysts out there, and if you do buy, maybe just do 1 or 2 shares this week while you get a feel for which way this thing is going to run. We'll see how it goes, but have a great day.